You might think earnings calls are, just these dry financial recaps. Pretty standard stuff.
Yeah, on the surface, maybe.
But if you dig a little deeper, you often find they're actually a surprisingly clear window into, well, major strategic shifts.
Exactly. And right now, a really big driver for those shifts,
Yeah.
it seems to be tariffs.
Absolutely. So for this deep dive, we've done just that. We've gone through the recent Q1 2025 earnings calls
Mm-hmm.
from four key semiconductor companies. NXP, that's NXPI, Qualcomm, QCOM, Texas Instruments, TXN, and STMicro Electronics, STM.PA.
Right. And our mission here really is to pull out the key insights. How are tariffs and all the sort of knock-on effects actually shaping these companies' strategies?
And their profits, their supply chain.
Precisely. We want to try and bring some clarity for you on what's really quite a complex issue.
Okay, so before we jump in, maybe just a quick bit of context on these four. They're all big semiconductor players, but they do different things, right?
Yeah, they have their niches. So Texas Instruments and STMicro, they have pretty broad portfolios, basic analog stuff all the way up to complex microcontrollers.
Okay.
NXP, they're more of a leader in specific areas like automotive chips, secure ID tech, things like that.
Got it. And Qualcomm.
Qualcomm, most people know them for, well, mobile phone processors, powerful chips, and wireless tech generally.
Right. So different players, different focuses. With that setup, let's look at who seemed most concerned about tariffs in these recent calls. Our tariff taco meter, if you will.
Okay, so based on our analysis, the company mentioning tariffs most often, that was Texas Instruments.
Really? TI?
Yeah. Their CEO, Haviv Ilan, he actually said, and this is a quote, that tariffs and geopolitics are disrupting global supply chains and creating unpredictable economic conditions. Pretty direct.
That is direct. Acknowledging it head on.
It definitely signals a higher level of concern, or at least impact.
Okay, so that's TI. Now contrast that with, say, NXP. What did we hear from them?
Well, NXP's CEO, Kurt Sievers, he said the direct tariff impact was immaterial.
Immaterial. Sounds like no big deal then.
But here's the catch. It's a really crucial caveat. He immediately added that they are not yet pricing in any indirect effects.
Ooh, okay. So the immediate hit might be small, but they're acknowledging there could be more coming down the line. Ripples.
Exactly. It's sort of cautious optimism, maybe. They're flagging it, but not quantifying it yet.
Interesting. So what about the overall tone then? If TI was maybe a bit more defensive.
Yeah, TI definitely leaned more defensive, kind of bracing for things. NXP and Qualcomm, on the other hand, their commentary felt, I'd say, more opportunistic, or at least adaptable. Like they see ways to navigate it, maybe even find advantages.
Adaptable, okay. So different levels of concern, different tones. Let's shift to how they're actually trying to protect their profitability, their bottom line, amidst all this pressure. Let's call it their margin armor.
Right. And here, Qualcomm really caught my eye.
Oh, yeah. How so?
They actually nudged their financial guidance upwards, despite all this tariff uncertainty floating around.
Wow, okay.
Yeah.
That suggests they feel pretty good about their position.
It really does. It points to strong pricing power, being able to charge what they need to. And probably pretty effective cost management as well.
Makes sense. Okay, what about NXP then? How's their armor looking?
NXP reported pretty solid free cash flow, about $427 million. And their gross margin was 56.1%.
56.1%. That sounds good, but how does it compare?
Well, that's the thing. It was actually down year over year by 210 basis points.
So down 2.1 percentage points. Not insignificant.
No. But their CFO, Bill Betts, he really emphasized their focus on restructuring. They're aiming for a 23% operating expense target.
Cutting costs.
Yeah. And importantly, they're continuing to invest in their own internal fabs, their own manufacturing plants.
Bringing production in-house, or at least having more internal capacity. That feels like a proactive move, right? More control.
Absolutely. It could definitely give them a buffer against some of those external cost pressures, like tariffs, down the line. It suggests they're building resilience.
Okay, resilience at NXP. Now let's look at STMicroelectronics. You mentioned their margins earlier.
Yeah, STM. It's a bit of a concerning picture there, margin-wise. While their operating expenses, their OPEX, came in better than expected.
Okay, good news there.
Their gross margin just collapsed, really, down 830 basis points year over year.
830. Wow, that's 8.3 percentage points. That's a massive hit.
It's a huge drop. And their response, They've announced plans to cut headcount over the next 3 years.
Right. A direct cost-saving measure driven by those margin pressures.
It clearly illustrates the kind of tough decisions companies are facing because of this environment.
So really different strategies for margin protection. Qualcomm leveraging market strength, NXP focusing inward on efficiency and capacity, and STM making pretty significant cuts.
The real spectrum of responses.
Definitely. Okay, let's move on to the physical side of things.
Yeah.
How are they actually adapting their global operations, their supply chains, this whole supply chain shuffle that seems to be happening?
Yeah, this is another area with really distinct strategies emerging. STM, for instance, seems heavily committed to what they call a China for China strategy.
China for China.
Meaning they're building up their capabilities within China to serve the Chinese market primarily from there. So things like their Ghanaian deals with InnoScience,
Okay.
foundry partnerships with H.H. Grace, a joint venture with Sinan. It's all about deepening their roots and partnerships inside China, a very strong regional focus.
Interesting. A very specific bet on that region. How does that compare to, say, NXP and TI?
Well, NXP and TI, they both use similar language. They talked about securing geopolitically dependable capacity.
Geopolitically dependable, that phrase definitely stands out. Sounds like a shift away from maybe perceived riskier areas.
That's certainly the implication. Building or sourcing from places seen as more stable. And TI, they specifically added a focus on flexibility and working really closely with their customers to manage these shifts.
So maybe less about putting all eggs in one basket like STM in China and more about diversification for TI and NXP.
Seems like it, spreading the risk, building resilience in different ways.
And what about Qualcomm? How do they fit into this supply chain picture?
Qualcomm's approach looks a bit broader. It's not just geographic shifts. They seem to be hedging through diversification of their business.
Ah, so moving into new markets.
Exactly. Pushing hard into areas like AI at the edge, devices doing AI processing locally. Also XR, extended reality, and industrial IoT.
Internet of Things for industry.
Right. So even if their core smartphone business faces tariff headwinds, they're building up other revenue streams that might be less exposed. It's a portfolio approach to risk management.
Spreading the bets across different technologies, not just geographies.
Yeah.
Clever.
It seems quite strategic.
Okay. Now, one thing that seemed, well, kind of missing from these calls was a clear number. Like, what's the combined impact of foreign exchange rates, FX, and tariffs on their earnings per share, their EPS?
That's a really sharp observation.
Yeah.
And you're right, none of the four explicitly quantified that combined hit, which is interesting given how significant both factors can be.
So, no hard number. Did we get any clues, though? Any hints?
We did get some clues. TI, for example, barely mentioned FX at all, but they did note having gross margin tailwinds from product mix.
Okay, so maybe FX wasn't a huge drag for them this quarter. Product mix helped offset other things?
That's one interpretation, yeah.
Yeah.
It suggests FX wasn't the main headline for their margins.
What about Qualcomm?
Qualcomm's guidance, their forecast, explicitly includes tariffs as they stand today.
As they stand today, meaning they're not building in any potential escalation of tariffs right now?
Seems that way. They're basing their numbers on the current situation.
Okay. And STM?
STM took the opposite tack, almost. Their guidance specifically excludes any potential future tariff shocks.
Excludes them. So that highlights a potential downside risk, doesn't it? If tariffs do worsen, their numbers could take a hit they haven't planned for.
Precisely. It leaves them exposed if things escalate.
So this lack of a clear combined number, you have to ask, right? Is this just companies being strategically cagey, keeping their cards close to the vest?
Or is it perhaps a sign that it's just incredibly complex to model accurately? Or maybe a lack of transparency that investors should be aware of?
Yeah, it's definitely something for you, the listener, to think about when you're looking at these company reports. What aren't they saying explicitly?
Absolutely. Now let's broaden the lens a bit more. Think about the political risks. How did these companies talk about, or maybe just allude to, those broader trade and political tensions?
Good question. Because it's all interconnected.
It is. And actually, Qualcomm was the only one, really, to directly mention global trade issues as part of their macro outlook discussion.
Oh, interesting. They named it specifically.
They did. But what was skillful was how they did it. They acknowledged the challenge, but still managed to maintain a pretty positive overall tone for investors.
That's a communication balancing act, for sure. Acknowledging reality without spooking the market.
Very much so. Then you have TI, going back to that phrase.
Geopolitically dependable capacity.
Exactly. You could read that as more than just supply chain talk. Could it maybe hint at lobbying efforts? Or at least strategic positioning with governments? signaling they're aligned with certain geopolitical aims.
That's a fascinating thought. It's certainly a carefully chosen phrase. It carries weight.
It feels intentional, doesn't it?
Yeah. And then there's STM, given their big China for China push.
Right. Their position seems potentially more vulnerable, politically speaking.
How so?
Well, if trade policies towards China tighten up, either from Europe or the U.S., STM, with its significant and growing focus there, could be one of the first companies to feel the squeeze.
So their strategic bet on China carries inherent political risk in this current climate. Growth potential, but risk too.
Definitely a key factor to watch for them.
Okay, so pulling all these threads together, the tariff talk, the margin strategies, the supply chain moves, the political nuances, can we start to identify some potential winners and losers in this landscape based on these Q1 calls, at least?
I think we can start to sketch that out, yeah.
All right, let's break it down. Who looks like they might be navigating this relatively well? A potential winner.
Well, based on their commentary, Texas Instruments looks pretty well positioned.
Okay, YTI.
They're clear steps towards that dependable capacity, their focus on working with customers through the shifts, and just their generally balanced communication.
Yeah.
They all suggest they're quite prepared. They seem proactive in building resilience.
Proactive resilience. I like that. Okay, who else?
NXP. Maybe a bit quieter on the tariff impact itself,
But their actions.
Exactly. Their consistent investment in their own fabs, building that internal capability, plus having strong cash reserves.
Yeah.
It positions them really well to potentially make strategic moves if opportunities arise from all this disruption. They seem to be playing a longer game, perhaps.
Building a war chest and capability. Okay. Any potential upside surprises we should watch?
Qualcomm, maybe? Their diversification strategy is key here.
Into AI, XR, IoT.
Right. That broad exposure to these fast-growing areas, which might be less directly hit by certain tariffs, could offer growth potential that maybe the market isn't fully appreciating yet. It's a built-in hedge.
Tariff-resistant diversification. Got it. Now, on the flip side, who seems to be facing the biggest challenges right now? The potential, well, loser in this specific context.
Based purely on the Q1 commentary and announced actions, STMicro seems to be facing the most significant headwinds.
Why STM specifically?
That heavy reliance on China, coupled with the really weak gross margin performance we discussed, and the fact they're now cutting headcount. It just paints a more challenging picture compared to the others.
And the big question there is,
has the market fully priced in those risks? Especially the risks tied to their concentrated China strategy in the current geopolitical environment. A valid question.
Definitely. So wrapping this all up, the big takeaway here seems clear. Tariffs aren't just, headlines or abstract economic policy.
Not at all. They are a very real, very tangible force that is actively reshaping how these major semiconductor companies operate.
Right. It's impacting their core strategies, their profitability, and forcing this massive rethink and reorganization of global supply chains.
Absolutely. And for you, the listener, whether you're looking at this from an investment angle or just trying to understand the big economic shifts.
It's so important to look past the surface news, isn't it?
It really is.
Yeah.
You need to consider these underlying strategic moves. How are companies actually responding? Who seems to be adapting effectively? Who might be struggling?
It adds a whole other layer to evaluating these companies.
Oh, sure.
And with that, maybe we can leave you with a final thought to mull over.
Okay.
When you see these individual companies, TI, NXP, Qualcomm, STM, making these micro-level adjustments, shifting supply chains, hedging bets in response to tariffs, how might all of that collectively end up shaping the macro picture, like the actual future of global technology development and the whole complex web of economic interdependence